We arrive at a neutral rating for Tesla with a price target of 229.62. Tesla is poised for solid expansion, but we find that most of its upside potential has already been priced in. Some of the investment positives include their highly differentiated product portfolio and business model, as well as the fact that because Tesla is a young firm, unlike many other auto manufacturers, they are not burdened with huge pension and other post-employment benefits and legacy costs. Lastly, Tesla is led by proven leadership with strong functional and technical knowledge. One of the key drivers for growth will be Tesla's partnership with Panasonic in the battery gigafactory. By the end of 2020, full function of the gigafactory is expected to reduce production costs of Tesla's battery pack by more than 30%. The high-performance battery is a significant portion of cost across all Tesla's vehicle models. Some upside risks for Tesla include long-term uncertainty in demand for the new electric vehicle category. This actually represents both an upside and downside risk. Next, as brand awareness for Tesla builds globally, the company would potentially enjoy material increase in demand for all their vehicles. Lastly, as the world supply of natural resources continues to drain, upward adjustments in prices of oil and natural gases could push consumers to move away from traditional fuel-powered vehicles to adopt all-electric cars, further increasing the demand for Tesla's models. For downside risk, Tesla's production unit is subject to highly volatile commodity markets such as aluminum, steel, nickel, and copper, which could potentially hurt Tesla's profit margin quite substantially. Tesla also owns its entire sales and service network, differing from the industry norm to utilize independently owned dealerships. They have also been blocked from direct sales in several states and the US. Although currently the only player in the electric car market, Tesla competes with larger auto OEMs who has the skills, technology, and capacity to develop new models to compete in the market with them. At the moment, Land Rover is reported to be preparing for an all-electric vehicle, Range Rover CUV, very much similar to Tesla's Model S.
For the relative valuation, we started by the regression approach, where we regressed the price-to-sales ratio against the risk parameter beta, earnings growth rate, profit margin, and payout ratio in order to control for these variables. This gave us the illustrated estimates and a corresponding R-squared of approximately 78%. Though when further examining the coefficients, we see that both beta and payout ratio are statistically insignificant at a 5% significance level. We believe that this problem arises due to multicollinearity and the fact that each variable in the model are correlated with each other and hence causing increased standard errors when estimating the coefficients. And therefore we are not very comfortable by using this model. Afterwards we tried to plot the PS ratio against the profit margin to see whether we could find a linear relationship between the two variables, but it quickly became clear that the relationship was more like a smiley faced and or a curved relationship. And when we tried to regress the price to sales ratio against profit margin, we saw that the coefficient on the profit margin was statistically insignificant and had a low R-squared. So we wouldn't use that model either. One solution could be to take the log of the profit margin and see whether we could find a linear relationship between the two variables in that case, but by taking the log of the profit margin, we would exclude the negative earning companies and thereby bias the data sets towards positive earning companies.
So now it's time for the fundamentals of the relative valuation. So we believe that Tesla will be able to generate high growth over the next 10 years and then enter a stable state. In this high growth period, Tesla will enjoy higher profit margins than the average in the industry, due to its competitive edge in manufacturing electric vehicles and the increasing demand for environmental friendly automobiles. This will lead to an average profit margin of 6% during high growth, which will converge to industry average during stable growth due to increased competition. Since there is no available information about target return on equity, this is assumed to be 15% during high growth and decrease to 10% in stable growth. We are assuming that Tesla will be able to maintain a growth rate of 12% in net income, since the current level is negative and expected to increase gradually in the coming years. In order to generate the assumed growth, Tesla will have to retain 80% of earnings, thereby paying out 20% in high growth and 70% in stable growth. The cost of equity is assumed to be 8.5% in high growth and fall to 8% in stable growth as the company matures and the riskiness decline. This gives the following assumptions for Tesla Motors. Using the price to sales equation, we find a price to sale ratio of 6.22. 30th of October 2014, Tesla was trading with a price to sales ratio of 12.05, making it highly overvalued.
We have done a discounted cash flow valuation of Tesla. By projecting future cash flow to the firm, we have made some explicit assumption about the future, which of course affect the estimated share price. This table shows the different revenue growth rates we have projected for the budget period and the terminal period. The current growth rate is 21.01%, and we believe that this growth rate is too low for the 5 following years, and have adjusted it up to 45% for the next 5 years. This can be justified by Tesla's future product portfolio, which will consist of more models with the potential to capture larger shares of the market and increasingly brand awareness. We expect the high growth period to last until year 2020. From this year, the growth rate is reduced linearly to 3%, which reflects the growth rate in terminal year. By applying these growth rates, we project Tesla's revenues in terminal year to be $38,721 million. Regarding revenues, this will place Tesla somewhat between Audi and Porsche. We believe that this is a fair judgment on their future position and justifies the applied revenue growth rates. This table provides our estimated operating margins the 10 following years and the terminal year. The assumptions made when deciding what margins to apply rely on both the industry average operating margins and own assumptions about the future outlook. The automobile industry average operating margin for the 25 top revenues firms is calculated to be 6.56%. We believe that Tesla's margin will approaching this as the firm matures. However, we think that Tesla can sustain a somewhat higher margin because of the technological and innovative aspect of the business and the announced Gigafactory. With this in mind, we will steer the operating margins to approach 10% in steady state. To estimate the reinvestment need, we have attached the reinvestment to the growth in revenues. To make this connection, we have found out how much sales each dollar of invested capital generates. This is the sales capital ratio and let us know how much capital we need to invest to generate the assumed growth in revenues. We have calculated the reinvestment need by applying the average sales capital ratio of 2.65 each year. The corresponding ROC is calculated and operates as a reality check. The corresponding return on capital seems reasonable and we therefore have faith in our projections of the reinvestment needs. In stable state, we believe that the return on capital will approach 10%, which is near the median ROC for mature automobile firms.
Now for the value per share. Using all the stated assumptions, estimations, and projections, we arrive at Tesla's future free cash flow to firm by subtracting reinvestment from after-tax operating earnings. We discounted each cash flow to present by applying the cumulated cost of capital. Summing up the present value of the cash flow gave us a value for operating assets. When we added back cash and subtracted out debt and value of options outstanding, we got a value of equity of approximately 28,610 millions. Dividing this by the number of shares outstanding gave us an estimated value per share of $229.62. To see how sensitive our estimation of the share price is, we did a scenario analysis and a sensitivity analysis. The sensitivity analysis shows that our estimated share price is highly depending on the cost of capital in steady state and growth in revenues in steady state. The scenario analysis shows that if Tesla's revenue will approach Audi's revenues and at the same time achieve better margins, we will get a share price of $503. If Tesla revenues decreases and approaches Porsche's revenues and have lower margins, the share price will be around $42. The final recommendations. We will stick to the result from the DCF valuation because we believe that this model builds on more accurate and justified assumptions than the relative valuation model. Neither could the relative valuation provide any conclusive result on Tesla's standing compared to similar companies. We will therefore stand by our rating from the DCF valuation, and our final recommendation is therefore neutral